A little bit of a very short background. I think that's a little bit of characterizing what the real estate markets in general are about. It's a little bit of we have a very, let's say, not very dynamic growth environment when we look at the economy. Might it be GDP growth or inflation? I think it's still something it's not very dynamic, not very pushy in the sense that you can bet any kind of investment strategy on kind of these growth drivers to a large extent. But on the other hand, what you see is what I just wanted to a little bit exemplify with these kind of investment intention survey, that target allocations for real estate of any institutional investor are increasing over the last years continuously. And that always brings the institutional investor a bit of trying to catch up with their target allocation. They're always falling short of their target allocation. That's what we see with these kind of record investment volumes going for real estate. And with these investment volumes, a lot of sectors that, let's say, 4 or 5 years ago have not been that much in the focus of institutional investors have opened up and have seen a lot of investment flowing into these areas. And residential is definitely one of these because, let's say, 6 years ago, resi was mainly an investment scene in Germany to a large extent, possibly in Sweden. The Netherlands was a little bit of a different breed of market, very socially oriented. But since the last 5 years, with these pressure of investors investing to find assets, and also with some legal and structural changes going on in the European residential markets, and some attitude changes in towards residential from the political side going on, you've seen residential markets opening up for investments in Denmark, in the Netherlands. Also in the UK, you see a lot of political activity trying to push the residential market to get more activity on the rental side going onwards. And that really is one of the drivers that changed the landscape for residential in the last 5 years, because today you really can say you have a pan-European residential market in the sense that you really can execute a pan-European residential investment strategy. So the other part of the residential story is what we've seen now in the last, let's say, 2 years is that the housing cycle also has let's say, bottom out. House prices are rising again. And I think in some countries they're already getting problematic again in the sense that if you try to get rented housing, rented apartments on the market as an investment, you always have to the developer has a decision to make. Does he want to build for sale or does he want to build something for rent? And that is, with these house prices increasing again, this competition actually in some markets has increased heavily, because for most developers it's much more profitable to go for the for sale segment than purely for the rental segment. And therefore also for the investor side, it's not that easy. Although everybody agrees that there's a housing shortage in the market, it's not that easy to really fill this gap, because most of the time for the developers, they don't want to release large chunks of apartments in one block, because that might bring prices under pressure, and that's a lot of segments for them, the more profitable segment. But talking about residential, and I think that's similar to what we see also in the commercial side, it's not so much about countries, although I think in residential countries are much more of a theme than for office and retail, because the residential markets are much more nationalized, the legislation is much more nationalized. But ultimately also residential is about cities, about going to cities, investing in cities, and given the demographic changes underway in Europe and in the single countries within Europe, and they're not identical. Yes, we have an aging population across Europe, but I think the structure and the process is very different in all the countries. It's a story. It's something about investing in cities, but again, you have to keep in mind these kind of what I try to exemplify with this regulatory picture is it's very hard to really understand that you have in every European country a very different group of regulations telling you how you are able to set your rent. You might have a very liberal environment in the UK, in Finland. On the other end, you have Sweden as a European country that heavily regulates how rents are set. You have a very diverse set of regulations covering the tenant-landlord relationship, like how can you allocate some taxes, some additional costs for maintaining of the building between the landlord and the tenant. And all this really gives you also a challenge if you want to establish a pan-European resi strategy, because you have to understand this. And then what I mentioned beforehand, you see a lot of changes in these regulations going on. Example might be the Netherlands, where you see the government tries to push to ease the regulation, to get more private capital in the market, to get more rental housing built, to deal with the housing shortage. In Germany, we go a little bit of an opposite way. We also acknowledge we have a housing shortage, so we have to regulate more and hope that more rental housing will be built going forward. You can be a little cynical in saying possibly by regulating the rental segment, the German government finally succeeds in increasing the owner occupancy rate, because the regulation might ultimately have an effect on quality. So I think that is the other part that you have to keep in mind. And that is actually the result of these kind of regulatory picture. These are about 50 cities in Europe. We're looking at the population growth on the x-axis, and on the y-axis we have rental growth over the last 5 years. And what you see is that there is actually not a real relationship between population growth and rental growth. So yes, residential is about growing population, but rental growth is not about growing population, it's about the regulation in the markets. And you see what I picture on the upper right-hand side is the two countries where we have a little more data points on cities. It's Germany and France. And you see that the French rent regulation is so strict that population growth really has no effect on rental growth at all, because it's centrally, the rent increases allowed by law are centrally set by an index, so it doesn't matter if the population is growing 5% or 0. In Germany, it's a little more that population growth has an influence, but it only explains about 25% of the rental growth we see in the market, and therefore, developing a pure residential investment strategy solely on saying we speculate on population growth, it's a little bit of a step too short, because at the end you have to understand what's going on around this. And that's the point. The demographic factors are heavily indirectly influencing, because GDP per capita is one of these drivers that drives rental growth to a much larger extent than population growth. It is related to population growth in the sense that as it's per capita, so population growth has an indirect effect on GDP per capita, but it also has a wealth effect in it, saying that tells you a little more about that households today are actually willing to accept some higher prices if they get a decent quality rental apartment in a centrally located city. And that finally is why a lot of institutions still look at resi. It's an attractively priced market compared to 10-year government bond deals, as we've done it here, because let's say rental loss in residential, it's quite limited. If one of your tenants is not paying in the portfolio, it's not really a big driver on your cash flow side. So the security of cash flow is comparable to that of a 10-year government bond. You might have less liquidity, that's for sure. But nevertheless, you have some quite attractive alternative exit options if you have a rental block, so that might compensate partly for this lower liquidity. So keeping this in mind, I would say resi is still very attractively priced segment, but it's also an increasingly competitive environment, seeing all these players emerging, trying to capture the development that institutions are getting back to the residential sector. Because it's not the way that institutions are really discovering residential for the first time, because you have to say, a lot of insurance companies, they historically invested in residential. Also in the UK, you had an established rental market, let's say 50, 60 years ago. It's just a re-emergence of residential for a lot of institutional players. An attractive play. And I think that is one of the interesting things we will see going forward. And that also materializes in the expected total returns. They are driven more or less by cash flow. It's not that you can speculate a large on capital value growth. You might have capital value growth in a lot of cities and in some special circumstances driven by the owner occupancy prices. But overall, if you go for residential, it's a play for cash flow. It's not a play for capital growth in most markets going forward. So that as a pan-European introduction. And now I want to hand over to a more German-focused, student housing-focused part of it.